They have to know that they're going to be able to make money. Now, the next fifth, sixth, and seventh step go quickly. It'll be about 30 minutes for the three of them. And then we're going to start on transactions. Now, I'm going to put these out for those that want to look at them. These are three different deals that show purported financial analysis. If any of you are doing this, there's a reason why you haven't done any deals. Your brother could do this with his eyes closed. She has a brother who's the head of an entrepreneurial program at University of Arizona. He's on our board, shareholder with us, a real financial PhD financial wizard. We have him not just for name. We think we can trust him. It's her brother, but they got different last names, and based on him slapping her around a little here in the negotiation of him being a partner of ours, yeah, I'm not so sure we can trust him. But anyway, because blood's thicker than water and money's thicker than both. And if you think any different, you're crazy. So I'm going to leave these up here, and I'll leave them here on the corner for those that want to look at them. When we come back from lunch, or before we go to lunch, this is a picture that was taken of our London group at the seminar. Almost everybody's in this photo that was taken. And this was, we had, I think, 8 or 9 countries represented from Europe. We had also Australia represented. And kind of, well, you came in at the end, so, but I mean, because even though they say they're from England, they're from South Africa, which is significantly different than being from the south of England. And, which is an understatement. I got to be careful because we got English here. See, so we can't take the Mickey out of them, as they would say. Yeah, but I mean, this is a picture of the group, and to show you how. And Europeans, I mean, the first 2 or 3 or 4 hours, it was tough. You could cut the air with a chainsaw, and for the first time, I realized that I speak fairly quickly anyway, but they were translating from different languages. And so the Austrian and the Dutch, they said, can we slow down? Because when they're translating from English to Dutch or English to Austrian, which is quasi-German, the Austrian wouldn't like me saying that. Of course, the ones that probably had the hardest time translating were the tailors. And they ostensibly speak English. And I was introduced, I had never seen mind mapping. I didn't know what that meant. But everybody in the front row was doodling, this kind of doodle stuff. And I'm looking around, and then I realized everybody in the front row was mind mapping. And mind mapping is a different way of taking notes. And it's, I guess, in theory, structured on the way our brain takes in information. And but I thought all these guys were doodling. I said, I must not be getting across to these Europeans. I mean, everybody's drawing. But okay. Are there any questions before we break for lunch? We're having lunch in the next room, I believe. And any questions? No questions. Let's break. We will take... what? I said in the next room. Yeah. It is now almost exactly 12 by my watch. We will meet back here at 1:15. There were a few questions that were asked of me at lunch that I've asked them to be repeated for the benefit of the audience. And some of the questions weren't asked because they thought they weren't germane to the rest of the audience, or because you were too low on the doofus feeding chain to ask the question. This seminar is about allowing you to become more comfortable with your abilities to go out and buy companies. And remember, how does it apply to me, and how do I take direct action? I used to have a big deal right up here, and we don't do that anymore because we give you the benefit of the doubt that you can remember those two questions. How does it apply to me, and how do I take direct action? What we should add there is as fast as humanly possible, because this is about growth today, not growth 10 years from now. So there were a couple of questions at lunch, or before lunch.
Yes, of my
Three-part question.
It's three-part question.
It's like a $64,000 question used to be on TV. Go
Okay.
ahead.
Since I'm a starter in the acquisition, the first question is how I'm concerned about the internal people that I have right now. How would I deal with them, and which part of them will be involved in the acquisition? And now my internal controller, would he be part of the deal, the team? I understand that you do need a board of directors, and you do need the accounting firm. You do need a lawyer. But what would my position be? How would I be involved in my existing people?
Okay. Assuming that your controller, for example, is the person that you want to be controller. And I'm not going to get into whether it's your relative or any of that crap. I mean, I very seldom have seen husband-wife deals work. The Verdeers is an exception to the rule. I mean, where they're both actively in business. I very seldom have seen brothers and sisters and sisters and sisters and brothers and brothers. I just haven't. So I'm just going to assume certain things. I'm not going to get into, you know, it's my father-in-law and all that stuff. Okay. If this is a high-performance person, and you know he or she is either high-performance or they're not. Okay. If it's a high-performance person, then your controller, by all means, is part of the acquisition team. By all means. Your controller, which is this the highest financial guy you have in the company? Okay. He will be the one, if any numbers are crunched, along with the accountants, what will make, does this acquisition make sense? Absolutely. Your senior, if you have a legal person, some, you know, like an in-house general counsel or lawyer on your deal, in your team, I mean within the company, I'm not talking about your lawyers, and you have a financial person, your senior legal person and your senior financial person, by definition, are part of this acquisition team. Now, for those of you that have mature organizations, you may very well have a head of mergers and acquisitions. If I remember correctly, probably no company in this room is big enough to have such a person. Although one or two of you think that you are big enough. I mean, I had a senior VP of mergers and acquisitions. His name was Jim Pritchard. And he was an astrophysicist with an MBA. But he had a great attitude. But he happened to have a lot of education, too. So he would be part of that team. You need someone to delegate the financial part of it. For some of you that don't have a financial person in-house, you will use your accountants, and they will act as your quasi financial person. All dream teams should have a financial person on them. This is the board dream team. A financial person on them, a legal person on them, and by finance, I differentiate from accounting. Accounting is more or less a bean counter. The accountant person that I showed you the resume was a real financial person. He had done transactions. There's a whole difference between being an audit partner or a tax partner with a Big Six firm and doing deals as an audit partner. Normally the audit partner does it. There's a big difference. And so you should have an accounting person on the board. You should have somebody that's from your industry, preferably. That's a name person. She's talking to Steve Jobs. If any one of those can't be filled, the legal, you can always buy a mouthpiece outside. In the companies that I've been involved in, the bigger companies, we've always had in-house lawyers. For example, Governor Hugh Carey is a very capable lawyer. He was on a board of mine for a long, long time, and right now we're trying to get him in on one or two of my other boards that I'm currently on. So these are musts, and you'll be able to find these people for 1 or 2% equity. All the directors, when I founded Great Western Resources, got the equivalent of 1% of the company. I didn't know it. I didn't think of it that way at the time, but now I look back, they all got 200,000 shares of the company, and we had 20 million. Yeah, that's 1%. Yeah, we had 20 million shares. in hindsight, because now that I'm doing these seminars, I've looked at all the stuff that worked. At the time, I just thought 200,000 shares sounded like the right number. Now I realize it's 1% of the company. And now I realize what an impact it had. I mean, these guys will jump, you know.
Each or altogether?
Oh, each.
Is that a 1% of the existing company or 1%?
Okay. Yeah, use the mic.
Is 1% of the existing company or 1% of overall the company with the new acquisition you've done?
No, 1% of the existing company. This means you will have to take equity out of your cheap, miserable hides and give it to somebody for free. This is like a J. Abraham free. This is freer than free. This is really free. And I've never seen Jay give away anything myself. But, I mean, this is for real. You give it to him. You don't, I mean, you actually give it to him. You have no idea. When we were having lunch, Andy and I, in Anaheim a few days ago, and we're talking to this guy, and he seemed interested. And then I said, when we're going to give you equity free, his whole demeanor changed. The guy lit up. All of a sudden, he wasn't just getting a free lunch. And this is a senior guy, 55, 60 years old, something like that. Yeah, he's a senior guy. And he's a well-respected name in the industry. Arguably, maybe the most recognized name in the industry. In his eyes, he was sitting there like this with his hand on his chin on the table. And when I said equity for free, his hand dropped, his eyes got big, and then he came up with all kinds of acquisition ideas. I mean, companies. He says, well, I mean, the guy caught on fire. Andrew Carnegie was not a stupid man. The primary motive has got to be financial. That was number one on his list. He was not stupid. He was from Scotland. Okay, what's the second part of the mic?
The second part of the question, if I have in mind 3 companies to purchase right now. Now, would it be a good idea if these people know me, they are competitors of mine, would it be a good idea for me to call them, pick up the phone and call them, or someone else to call them?
Okay.
And if I don't know them, would that make a difference?
Okay. Do these people hate you, dislike you?
One of them does.
Okay. How you contact companies depends on, one, if they hate you. If you think that you're going to be a detriment to the transaction, then you don't do it. If there's any chance of you being a detriment to the transaction, you don't do it. One of the benefits we have in Jose and Lucinda's in my company is they don't know Lucinda. If they knew her, we probably wouldn't be getting any offers accepted at all. See, because we're giving these offers blanket, blind. See, they don't know how tough she can be. For those of you that fall into that category, and the Taylors may fall into this category because you're well known in your industry, if there's any remote chance of you not being a positive in the equation, then you don't do it. You have an intermediary. That's what you have lawyers and accountants for. They can do it. You have Casey Stevenson actually hired somebody and paid him $50,000 to close the biggest acquisition he ever did in his life. And it irritated the hell out of him to pay the guy $50,000, but, it was well worth it. I mean, Casey made millions. But it stuck right here. And for some of you, it will stick. And for some of you, you won't be able to get past that sticking. Because this guy wanted $50,000 whether the deal went through or not. Escrowed. And he did it. Of course, I wanted him to do that because that gave extra incentive for Casey to make sure the deal closed. Because he wasn't going to pay this prick $50,000 for nothing, no matter what happened. See, so that worked to our benefit. Casey didn't like it. Okay, the next question.
The third part, if I know my competitor, for example, they're doing $3 million in business and they're profiting $400,000 a year, how would I know how much I should offer them that is economically is feasible for me, for my company, to merge with my company or as a separate entity?
Offers are based on, we're getting ahead of ourselves, but these are good questions. Offers are based on existing cash flow from the company. You guys, at your stage of your career, you're not going to be able to make an offer on company A knowing that you're going to be able to double their business and make the offer based on the doubling of the business. You guys aren't that good yet. So initially, your offers are going to be based on the existing cash flow, debt service. How much cash flow does this company have to service how much debt? And you back into your acquisition price or your acquisition offer. You back into it. Lucinda is making these offers based on existing cash flow, knowing in our heart of hearts that in some cases we're going to double and triple cash flow, but the offer that we make is based on existing cash flow. And when we go to the banks to get 70 or 75 or 80% finance, which is traditional finance, it's based on the existing cash flow. I have made purchases in my career based on the pretend cash flow that MBAs love to crunch out of numbers, because we're going to take advantage of all these economies of scale and all these efficiencies and all this synergies and all this crap. That was Nabisco. $22 billion offer was based on, we're going to sell off these many assets, we're going to reduce debt. That's all. Yeah, you guys are not at that stage of your careers, unless you have somebody on your dream team that is. And that's the whole reason you have a dream team. That's the whole reason you have somebody like me. I can smell death in the air, and I can smell, and Lucinda's is the first real estate deal I've done in 25 years. We tweaked it a couple ways, and she was smart enough to say, this is a good thing, tweaking it, because Dan likes it now. And now it's basically a license to steal. I mean, basically, we ought to be there with a mask and a gun, like Jesse James in this deal. And now, because I have a little more confidence in real estate, I'm actually looking at other real estate deals now. But you know what I do? I send them to Lucinda to look at. What do you think of this? I said, that's just bullshit, Dan, this deal. She's a big expert now, see? She's become an expert. It's funny how success makes you an expert. It's funny how that works. You heard me say this. You know, we're all products we're all self-made. Only successful people admit it. We're all self-made, ladies and gentlemen. Only successful people admit it. Okay? So the answer is it's based on the current cash flow, and that's the offer. For example, this company does $3 million in business. It makes $400,000 before after taxes. Before taxes, so what does it make? $250 after taxes?
After taxes, let's say 250.
Okay, probably cash flows. Cash flows are probably, depending on depreciation. Does that have things to depreciate?
Yes, including
Okay,
depreciation.
so maybe cash flows $500,000 or $600,000 a year. The bank's going to be looking at what there's different definitions of cash flow. Disposable cash flow that can service debt. Okay, so let's just say it's $500,000 a year, or $500,000 or $600,000 a year. The bank is going to want to have debt service covered minimum 1.5 times. So they're going to allow you to borrow, for example, $400,000. Your payment will have to be $400,000, and your cash flow $600,000. So now your debt service is covered 1.5 times. Some banks, if you don't have any track record and you go in there with your, your putts in your hand, are going to want 2 times debt service. So that means they're only going to loan you, or the debt service will be $300,000 a year on your $600,000 cash flow. And for those of you, this is your first deal, and you got no dream team, and it's a good deal, they're going to want to see 2.5 to 3 times debt service, because they don't trust your management. And that means then 3 times would be, they'll allow debt service to be $200,000 a year. And I'm talking about pure debt service. I'm not talking about debt service and paying back a principal. I'm just talking about the interest on the debt. Now, I've gone in and done deals where I'm 50% of debt service because they believe that I can do it. When I say it's Christmas, in July you hang your Christmas stocking. That's why, how do you create an instant track record? You partner up your first few deals with somebody that's got a track record. And then your track record is their track record. The Taylors have a long track record now. In that your packet is my profile. That is the condensed version of my business accomplishments in the last 25 years. And they are significant. Oh, Scott Fair, which are my partners in Edinburgh that are in the construction business, that are young lads, that these two young lads said, you got to go to listen to this guy in Orlando, and they did. As we speak today, we're meeting with the Bank of Scotland with Valerie, who's a fellow director of mine. She is a shareholder of my holding company, along with Lorraine and Leanne. She went to the bank, and she was negotiating with the Bank of Scotland because the Bank of Scotland is basically sticking them around. And the Bank of Scotland is my primary bank, and they have not gotten to the interviewing of financial institutions yet because they're still putting their dream team together, their board. But the bank has come in and shut down their overdraft, which means cut off their lines of credit. And you can't run a construction company without lines of credit. You just can't. So they were, like Valerie called it, they were not panicking exactly, but they need to talk to you. They're a wee bit nervous. And so I talked to them, and so I had Valerie go down there and slap the bank around, and I got a fax this morning that basically said the bank acquiesced and is going to play ball with them. And in the meantime, they're playing ball and saying everything's all right. We're going to another bank. I said, you better hurry up and find another bank because we obviously can't do business here. Now, Valerie, 5 years ago, could no more go down and talk to the Bank of Scotland. This is a woman, an English woman at that, who doesn't love Scots to begin with, down there and hammer the bank. You know why she's good at it now? She's probably better than anybody in the room other than me, because I forced her, and this is a woman that she has to wear high neck thing because her neck turns red when she gets nervous. She's got to wear, not turtleneck, what do you call them? A turtleneck. Yeah, up to here because her neck gets red when she feels anxiety. And now she's down there for my new partners hammering the crap out of Bank of Scotland because I've thrown her into the breach. I just keep throwing her in there and bringing her back bloody. Bringing her back bloody. And now she can do it. She still doesn't love it, but she can do it. I don't know if she still wears turtlenecks. I haven't been to these meetings. But she negotiates my personal overdrafts, which we live on in Scotland, with the Bank of Scotland. Okay, was there...
The question that
Okay.
Regarding the financing that you mentioned, you paid the interest,
Correct.
1/3 of it. How many years is the deal financed usually through the bank? Do they go to 5 years, 7
no,
years?
it varies all over the... And these are general rules of thumb, but normally financial institutions, and this depends on industry to industry, normally financial institutions don't want to lend out past, other than real estate oriented, don't want to lend out past 5 to 7 years. 5 to 7 years. On real estate, I mean, you can take them out, well, you take them out as far as you can, but 15, 20 years, and sometimes the amortization is different. I've had long-term finance, I've had bridge financing or short-term financing that was supposed to be paid off in a year, last 12 years. And when you get good at it, you borrow, and we're going to talk about that, when you borrow more than you need. I bought a $4 million house for my wife and borrowed $5 million. No equity. Not a dime. Not a nickel of my own dough. I bought Guthrie Castle on a 10-year note, interest only, and I didn't even pay him, I wouldn't even pay him interest. I just tell him to keep rolling it into the debt, which is paid off now. I borrowed many, many times what the purchase price of the castle was over a 3, 4, 5 year period. But I've got 300 financial transactions. I can say with my hand in my heart, as they say in Europe, that I've never not paid off a bank's principal. You notice I don't say principal and interest. And the bank understands it. They hear it right away. But in my industry, when oil went from $40 to $8 a barrel, they ought to get down and kiss my ass and give me a month to draw a crowd. I'm the only guy I know that paid off all his money debt in the energy business and when the oil went from $40 to $8. And I wear that as a badge of honor. And the banks know that. Well, if this guy paid off, that means my assets every 180 days were halving. Every 180 days, they went down by 50%. You know, at least I don't think anybody in the room's got any kind of track record. So the banks will give you more latitude. That's why the key is to do transactions, because you can negotiate better terms. You can demand better terms, not forget negotiate. I tell banks, I don't care what interest rate you charge me. I just want the money when I want it. When I want it. Is that okay? Any other questions? There was another question at lunch somebody asked me. Okay, give the mic back to Danny, please. Oh. Okay. Yeah.
Hi there. My question was, I asked Bruce last night when we were having a couple of beers, but I just thought I'd
Was
like
this
to...
a couple? Who was buying?
who do you think?
Okay.
But I
They're in
thought...
a cash business, by the way. We're in a cash business.
That's right.
That's what we're in a cash business. They're in the legalized gambling.
Yeah.
They call it leisure, but it's so that's why you were buying. You're in a cash business. Go ahead.
Anyway, I just thought I'd like to hear it from the horse's mouth. So the question was, Scotland's a small place, and there's ourselves in partnership with you. There's Fair Scott as well in Edinburgh, and there could possibly be Stuart tomorrow in Glasgow, which is just down the road.
A Glaswegian.
A Ouija. The question was, when we are pitching, drawing the picture, selling the dream, should we preclude that there will be other partnerships with yourself, or just sell the dream as we're in business with Pena,
Correct.
And that's it, period?
Sell the dream as you're in business with me.
And they will find out. So when they do find out, what is your approach then?
Well, my approach is they know that of my business activities, i.e. in Scotland, have been, other than the castle and my grounds, have been next to none. And they know that, and I would tell them if they asked me, that I have found now 2 or 3 or 4 or whatever the number of transactions that were good enough to interest me and put my reputation on the line. And it doesn't mean, I mean, the same way in the United States. I mean, I've got people pitching Arthur Anderson and the lawyers in Phoenix, San Diego, Los Angeles, Jacksonville, Florida, New York. And Arthur Anderson, for sure, has Worldwide Computer. I mean, what they do in San Diego, they know in New York, and they know in Hong Kong. So my name has got to be getting flipped up there, and it's just as Richard Rainwater's name is flipped up, just as a lot of these other guys that acquire a lot of companies. So there's nothing wrong with that. There's nothing wrong with that. You use it from the glass. The other side of the equation is, you know, Dan only takes on things that are going to be a runner. A runner means good, that are going to do well. And you shouldn't even have to sell it. But if you're asked, or I know if I'm asked, that's the answer I'll give. Question? Would you pass the mic up, please?
You said that when you're creating your dream team, you give 1%.
Correct.
And that's
1 to 4%.
Sorry, 1 to 4%, and that would be in the original company. When you go after an acquisition, they don't get that same rollover.
No. But when you're buying companies, the holding company or the parent's going to own all the companies anyway. So by definition, if you own 4% of the company buying all the companies, the 4% trickles down to the same percentage of the companies you're acquiring.
So you're not rolling all the companies into one. You're holding as a holding
Well, no,
company with separate.
you can roll them all into one. If you roll them all into one, it's the same. He owns 4% of the roll-up, or he owns 4% of the wholly owned subsidiary. Let's say you spin off. We buy JC's company. It's a wholly owned subsidiary, and we sell it for $100 million. And he and these two gentlemen each have 2%. I mean, they're going to get $2 million each. And let's say you have, for example, I have 20 companies in my holding company, and let's say we sell one off. Lorraine and Valerie and Leanne have a piece of the holding company. If they haven't pissed me off, we'll make a cash distribution in the form of a dividend or in bonuses or whatever makes more sense tax-wise. Understand? Okay. Any other questions before we move forward? Okay. Now, acquisition and external growth is what the Raising Capital seminar is mostly about. And you have the list of the financial sources that we handed out to make it easier, although I already mentioned that some of you won't call because they're toll calls or whatever, but hopefully you will. And there's a difference between a Quantum Leap action plan and a business plan. The Quantum Leap action plan is your plan. The business plan is what morons give bankers. And on that note, I want to read something. You should have this in your deal package. And it's a letter February 23rd, 1996. And it's from an accounting firm. This is not in the Big Six, but they're like the 8th biggest accountant in Europe. And I'm not going to read it verbatim, but the bottom line is on the back of the page, where appropriate, making introductions to potential funders. Accounting firms raise you money now. Accounting firms raise you money. You have this letter dated 23 February from, or maybe you don't have that letter. Okay, this is okay. We didn't have time to put it in. This is a letter I just received. And this is to the two gentlemen that we're talking about in Scotland, Kenny and Scott, that I'm in the construction business. And this is a letter dated 23 February, and it's from Rutherford, Manson, and Dowds, which are the 8th or 9th largest accounting firm in the UK. And people, because I hear people always tell me that, I mean, accounting firms don't raise you money. Well, that's crap. They do. I mean, Coopers & Lybrand actually has a department. Coopers & Lybrand actually has a department set up. They charge 7% of the money raised in addition to their hourly fees.